Hello, everyone. Welcome to Hudson and Tim's reading group. We wish you all a happy week ahead and hope you had a restful weekend. My name is Masimba Kona, and I currently work at Hudson and Thames as a junior quantitative researcher slash analyst. And today I have a quite interesting paper for you guys, a paper that continues down this path of reinforcement learning and maybe help us explore potential benefits that deep reinforcement learning could bring to the table of financial trading. So the title of the paper is Deep Reinforcement Learning for Trading, can easily be found on the internet. And yeah, so let's get right into it. So the structure of today's presentation will be split into four main sections. The first section will be background. And under background, we're going to talk about financial trading pillars, how they govern our world, and how they shape what we are doing in terms of financial trading today. Then we're going to look at deep reinforcement learning, how that is similar to reinforcement learning, but the main components that make it different from reinforcement learning and what makes it deep reinforcement learning. And then we're going to look at the three reinforcement learning agents or models that we actually use in the paper, but we're going to use those as examples to show what deep reinforcement learning is versus reinforcement learning. And then we're going to look at the methodology. It's essentially we're trying to see this experiment setup that they used in the paper and how then they derive the results, which we then will talk about under results in discussion, which we will try and see how those results compare towards baseline models that they will use. And are they useful? We'll discuss that. And then lastly, we're going to look at the conclusion. Under the conclusion, we're just going to have some conclusion remarks. I want to leave you with something that you can remember and what I would want you to take out of the paper if, let's say, you potentially want to implement some of the things that were used in the paper. So let's get started. So before we get started, you may be wondering why I keep looking to my right. I have a bigger screen with the presentation and my laptop is here on the left with the recording. So it makes it easier for me to have them both separate as I manage the recording and the presentation. So let's get started. So we're going to start off with the three pillars of financial trading. It's no surprise that over the past 10, 20 years, financial trading has evolved into what it is today. So we'll start off with fundamental analysis. And under fundamental analysis, I think the core thing I would want you to understand is that this is trying to find the intrinsic value of the actual asset we have. So let's say if you're trading Apple stock, for example, you're trying to understand what is the true value of Apple in relation to some of the macroeconomic factors that influence Apple in terms of, for instance, even the statement of comprehensive income, for example, or statement of financial position. You're trying to understand what is the true value of this stock so that I understand if it's on the market, is it undervalued or or overvalued? And based on those factors, I can then make a financial decision, which is to either go long or go short. And then this gradually evolved into something that is known as technical analysis. Now, an approach of analyzing securities based on historical price is what is known as technical analysis. So you're using market indicators to try to find try to predict the path of the stock and the direction it is going. So you're looking at, for example, in the paper, they use RSI, which we'll talk about. They also use MACD, which is the moving average, convergence, divergence indicators. So you're essentially looking at graphs and historical data of the stock to try and understand, is this stock going to rise or is it going to fall? And by that, you're trying to pick up potential trends in the data and potential trends in the market. And then this gradually evolved to what we have today. And by the way, all of these three are not individually living in their own space. What I mean by that is they do overlap with each other. And you will find that, for example, in most financial trading strategies, they evolved all three. So, but anyway, so let's go to algorithmic trading, which is what I think 90% of our financial trading is guided by algorithmic trading. Now, this is essentially now using computer power to try and extend things like technical analysis, for example. Now you're trying to find those intricate trends in the data so you can essentially predict long-term or short-term. The goal here primarily is to pick up those trends in that data, but using computing power for help, for example. And like I said in the paper, they incorporated a bit of technical analysis, but using some of these indicators that I had mentioned earlier on. And of course, they use a lot of algorithmic trading to try and understand financial data and try to make incisive strategies. So you would think of it as at algorithms, which is algorithm trading. Under that, we have things like machine learning, excuse me. And then under machine learning, that's where we have something like reinforcement learning, for example. And then under reinforcement learning, then we have deep reinforcement learning. So it kind of forms like a chain of, or a network of how we get to deep reinforcement learning. So speaking of deep reinforcement learning, at its core, deep reinforcement learning is reinforcement learning, right? Imagine you have an agent, which is a computer program, or in our case, of course, is a model. This agent interacts with the environment. So by interacting with the environment, the agent or the model takes an action in the environment based on what it receives as feedback from the environment. And remember, the environment is just a space where there's all possible variables. So an example, I would describe the environments the authors use in the literature to get the results they have. So imagine we're in this environment, the agent is interacting with the environment to get feedback. Now, feedback is judged or governed by what we call a reward function. Now, this reward function is going to give us feedback to say that, are we doing well or are we doing bad? And if we're doing well, it's a reward. If we're doing bad, that's a punishment. So that's reinforcement at its core. Its main characteristics are the environment. And environment, we now talk about things like the state, so on. And then the agent, which is the actual model that is actually getting feedback from the environment and moving from states to different states to states, because a state is a moment in time. So you have ST plus 1, ST plus 2. So just to recap, reinforcement learning is governed by three things: state space, agent, reward. And within that environment or state space, we have action space. Action space is, what do I do when I receive information about the environment? That's it. At its core, that's reinforcement learning. And at its core also, that's deep reinforcement learning. So where deep reinforcement learning takes it a notch up is that instead of using handcrafted rules to guide the agent's action, like instead of using rigid rules to say, this is what I do in the action space, this is what I don't do, or this is what I do to receive a reward, this is what I do and I receive a punishment, and I update myself to ensure that I continually try to get better and better rewards, or more and more rewards, sorry. Deep reinforcement learning allows the agent, which is the model, to learn directly from the raw data. So it actually combines what we call deep neural networks. And we know deep neural networks are just neural networks, but with more layers. So the ability to pick up even more trends, or per se, in our case, in the data is even higher. So deep reinforcement learning adopts deep neural networks to understand the environment even further, so as to make the agent, or we will learn one of the agents, which is a Q learning function, so as to allow that agent to make better decisions going forward. That's deep reinforcement learning at its core. And the deep neural networks actually will see, or sorry, rather, I feel that deep reinforcement learning tends to exhibit a lot of overfitting. I think that is the case most of the time whenever we use neural networks or deep neural networks. But there are the papers that try to curb this by trying to split your data into training data, and so out of sample, in sample, and trying to understand the intricate details regarding those splits. And other techniques have been adapted also, but at its core, that is deep neural networks. And we'll talk about some of the overfitting potentials in the results and so on and so on. So the agent uses deep neural networks to understand the environment even better, right? And then through a process called training, the agent interacts with the environment and adjusts its neural networks based on the feedback it receives. Now, training, of course, will be shared with reinforcement learning, but what makes it different here is the adaptation of deep neural networks. So by repeatedly exploring and exploiting right? Through deep neural networks. So by repeatedly exploring and exploiting the environment, the agent gradually learns which action leads to higher rewards. Now, one of the most researched or most well-known agents is a Q learning function, which we'll talk about here. So we talked about deep reinforcement learning and how it is in the spectrum of the algorithmic trading space. And one of the most well-researched deep reinforcement learning algorithms is a Q learning algorithm, or rather deep Q learning algorithm. Now, a Q learning algorithm essentially is an algorithm that tries to do a trial and error scenario whereby it tries a specific parameter, gets feedback on that depending on the environment, the action space on, and then gets feedback and then stores that feedback in what they call a Q table. So try different parameters, get feedback, store that value. So store that state action value in a Q table. And then this allows us to create a Q table with all different scenarios of state action feedback. And then from that, the algorithm tries to carve a way through those scenarios to get the best cumulative rewards. So the goal in a deep Q learning algorithm is to essentially get the best cumulative rewards. Now, in its early inception in the 80s, they used to actually physically store these in a Q table. These Q values are in a Q table. And of course, with the way data has become more and more complex, this is just not feasible. And so deep Q learning then takes that up a notch by actually making that process of trial and error of storing state and action pairwise a bit better by actually understanding the data even more. So at its core, Q learning is almost like a trial and error algorithm. It's not guided by any policy to try and optimize the reward function, which is different from what we have in terms of policy gradients. Policy gradients directly optimize the policy function. Now, the policy function is essentially the same as the Q function, which is now the reward function. So policy gradients essentially use things like gradient descent to try and optimize that reward function. So instead of doing like a trial and error scenario, policy gradients are actually just a reinforcement learning algorithm that try to optimize our reward function using things like gradient descent. Now, one thing to note here is that policy gradients, like I just mentioned, is a reinforcement learning algorithm. If we take it to deep reinforcement, its counterpart is deep deterministic, policy gradient. And that's the model that actually then uses deep neural networks to understand the environment better and to actually optimize the policy function, which is a reward function, even better. Then we look at advantage actor critique, which is a model that I think Michael spoke about last week in the FinRL talk. Now, A2C is a reinforcement learning algorithm, not deep. If you were to take it to deep, then that would be A3C. But at its core, A2C is an action critique-based algorithm. So it tries to combine the properties of trial and error from Q learning algorithms, and then tries to combine those with the policy gradient function algorithms. And together, it tries to actually make more incisive paths to optimize cumulative rewards by trial and error and optimizing policy function simultaneously. So it does this in real time, essentially, which is what I wrote here. And I think that's about it that I would want to talk about in terms of A2C, because I know most of that was covered in last week's presentation. So now that we have a strong foundation of what trading space is and how we got to algorithmic trading in what we categorize monopole trading today, then we spoke about what deep reinforcement learning is in relation to reinforcement learning and how it actually is significantly different from reinforcement learning. We spoke about three common type of algorithms. Now, these are the three that we actually use in the paper to actually make those results that they have and compare them with some baseline models. Now let's talk about the actual paper and let's talk about how they set up the experiment to get to where they got in terms of the results. So now we're at methodology now, and like I think you may or may not have noticed, whenever I talk about reinforcement learning or deep reinforcement learning, there's three main categories that I always mention. You always have a state space, you always have an action space, and you always have a reward function slash policy function slash Q learning function. All right. So in terms of the paper, this is the setup they used when it comes to the results they got. So we start off with normalized close price. That's just standard. And then they use returns for 1 month, 2 months, 3 months, and 1 year. And then they use some indicators from technical analysis that are common in technical analysis. And these are the movement average, convergence, divergence, which I mentioned, and then the RSI, which is essentially the relative strength index. And then in the action space, maybe I didn't mention it already, but Q learning algorithms are governed by discrete policies, or they're guided by discrete action spaces, meaning that they can only have a certain distinct pathway or to rewards. So exactly what I mean by that is, for instance, the action space that they created in the experiment was governed by discrete and continuous. Discrete to say that -1, 0, or 1. So when I see information in the environment, or when I look in the information in the environment as an agent, what do I do? Your action is, if it's discrete, either go short fully, -1, do nothing, or 1, go long fully. There's nothing in between. And then what's different from discrete to continuous is that it's governed by between -1 and 1, and the model can determine the best cocktail per se of cumulative reward. So it can either go, let's say, 0.5 long or -0.6, something like that. And that's the essential difference. And DQN, or deep Q learning networks, are governed by discrete actions, as opposed to policy and A2C, which are guided by continuous actions. Yeah. And then looking at the reward function now, they adapted a commonly used reward function. Now, they mentioned that the reward function has a utility function that is actually for a risk neutral or risk insensitive investor. And you would know that if you look at the paper, when you look at the RT, and RT is just defined by PT minus 1. So the price is T minus the price is T minus 1. And all they care about is, did I make a profit or did I make a loss, and not looking at any risk, which I wouldn't then say then the reward function is guided by a risk insensitive investor, because it does include things like volatility target and the X and volatility at T minus 1, so the estimate. And so I wouldn't necessarily say that the reward function is guided by that, but this is the setup they use. More details regarding how the reward function is derived are in the paper or in other research, because it is a well-used reward function when it comes to reinforcement learning. So let's take it a step up again. Now let's look at the baseline models they compared to the reinforcement learning agents that they use. And the reinforcement learning agents, just a reminder, are the deep Q learning network, which is a deep reinforcement learning. The other two are just reinforcement learning agents. And this is the policy gradient and the A2C. So these are the three that they use to compare. We start off with the long only. Now, this is simply just a model that goes long, regardless of the scenario. And I think models that adopt such a policy will be perfect in a bull run. And then you look at a sine R, slightly different from a long R. It essentially changes its position based on the previous year's outcome. So if last year the market was actually up and this year's going to go down, it changes the sign from long to short, and so on and so on. And then you're looking at your moving average convergence divergence signal. This is just a model that's guided by that indicator. And then more of the experiment. Now, let's look at the data set. Now, they used 50 adjusted continuous features contracts, and this was ranging from 2005 to 2019. And the way they did it is that from 2005 to 2010 or 2011, 2010, they use that as a training data set. So this was out of sample. And then from 2011 to 2019, this was in sample. So this was used as a validation set. And that's important because that's also a technique that is used, like I mentioned, to try and prevent scenarios of overfitting. Because we know that in most scenarios, when a model performs very well in your training data, it most likely will perform extremely bad in your validation set. So this is one technique that they try to do to mitigate the scenario of overfitting. Of course, I think there is room for more research to be done to try and understand how you can try and prevent overfitting. Perhaps I will do more testing myself and actually understand other scenarios, for example. And then the data set consisted of different asset classes, sorry. You're looking at your commodities, equities, fixed income, and forex markets. If you want more details about the actual assets that they used and potentially how you can modify it for yourself, it is written in the paper, I think Appendix C or B. And this will give you a better understanding of which exact assets they used in the experiment. Because I think one thing to notice, this paper is from 2019. So things may be slightly different in 2023, and perhaps you'd want to modify it to your specific asset classes and see if, let's say, reinforcement learning or deep reinforcement learning could be beneficial for your strategies. And like I said, I mentioned from 2005 to 2010, this was the training data. Then 2011 to 2019, this was out of sample. And then from that, in order to create a scenario where they can actually judge the different models, they created portfolios with equal weighting. So for instance, the commodities portfolio will have all the commodities listed down and all carrying equal weightings. Of course, this will be different. Perhaps maybe you can adapt a CPO scenario, like I mentioned in, I think, the beginning of the month when I did a talk about that, where you try to optimize your portfolio for a specific case or scenario, depending on market conditions and so on. And then just looking at the metrics, nothing too surprising here, except for perhaps maybe Sotino. Sotino is just a variant of Sharpe ratio, but it actually just focuses mainly on the negative returns by adopting your downside volatility instead of just your normal volatility. And then we look at the results. Now, the results, at first, they seem a bit surprising. Like, for instance, you're looking at from top to bottom, you're looking at your commodity, equity, fixed, and then your forex. Now, like I said, they may seem surprising when you look at, for example, the equity index, which is this one on the right, and you're looking at that the long only strategy is the one that actually outperformed the others. But the authors did mention that this was probably because during that time there was essentially a bull run that occurred. So in a bull run, in terms of equity index, your markets are relatively going on a high, and and having a long only strategy, you will end up benefiting the most. But interestingly enough, if you look at DQN, which is the red here, it actually picks up that trend and actually goes on an upward trend as much as long only strategy is doing so. But then if you look at, for instance, the commodity market, which is highly volatile, a long only strategy performs abysmally because, of course, these are highly volatile markets and you need a model that will be able to adapt between going long or going short at very precise moments. And I think that's what DQN is probably exhibiting in this case, whereby despite, if you look at MACD starting to take a downward trend, or if you look at PG, which is policy gradient, or if you look at signal CR, which are signal CR is more or less leveling, but if you look at the other two I mentioned, they're actually starting to do a downward trend. DQN actually mitigates some of those instances where there's now a highly volatile market and still continues on an upward trend. And I think this is more so seen in the Forex market, whereby if you look at the other models, particularly if you look at the long only, if you look at the SINR, these are starting to go on a downward trend from about maybe 2015. DQN still continues on a high path and still tries to maintain positive rewards in that instance. Which is pretty significant because I think, like I mentioned, a lot of times whenever you use deep neural networks in any model, you are prone to overfitting. So when you see that out of sample data or out of sample out of sample trials are exhibiting positive rewards like this, I think that speaks for itself that perhaps deep reinforcement learning is something that could be adopted in a strategy and it actually yield positive rewards. I think the key here is to experiment more and more. The nice thing about this paper is that it lays out the experiment clearly and well, and their methodology is clear. definitions are clear, and also they were transparent in which assets they use in these portfolios. The only thing perhaps maybe that would have been wanted or needed is maybe the source code, so that if people want to adapt, let's say a deep neural network or a deep reinforcement learning agent, they can also follow the steps that were adopted and experiment with their different asset classes and so on. But nevertheless, I do appreciate that deep reinforcement learning is probably a topic or an industry, or sorry, rather, yes, a topic that is not explored enough in the markets or in quant analysts, research firms. And perhaps I think, especially with the trying times we're faced now with highly volatile markets, perhaps it's worth actually exploring to see if it can boost our strategies and maybe yield even more positive rewards, sorry. But I guess the key is to experiment with more and more asset classes with different scenarios, changing your reward function, experimenting with different action spaces, and also especially your state spaces. I think exploring with different indicators and other variables is important. And then looking at the results a little bit more in detail, I just wanted to note again, DQN having a significantly lower maximum drawdown than the others. I think the general theme here is that DQN outperformed in 4 or 5 portfolio scenarios. And this is significant because the paper is trying to show why deep reinforcement learning is a very valuable tool that you can add or potentially just fully adopt in your strategy. Another thing I also wanted to mention is that if you look at DQN and the Sharpe ratio, in most scenarios, it actually had a significantly higher Sharpe ratio. Like if you look at in commodity ones, remember commodities are highly volatile. It had a very high Sharpe ratio. If you look at equity, same theme. Fixed income almost at a 1 Sharpe ratio, which is extremely good. And then, of course, Forex, which are highly volatile. When you see things like long only, sign R, having negative Sharpe ratio, and also MACD having a very low Sharpe ratio, I think it's positive to see that DQN actually had a significantly high Sharpe ratio in that scenario. And that goes to show that deep reinforcement learning is actually available too. Like I said, all of these results are worth taking with a pinch of salt, because you need to understand that how can I adapt it in my own firm, or how can I adapt it in my own strategies? And perhaps the only thing I would only say about that is experiment with more results. Perhaps I will reach out to some of the authors. Maybe I could get the source code myself to try and experiment with different state spaces and so on, different variables and different indicators and different portfolios. But I think even if I don't get any luck in terms of that, the paper kind of outlines the pathway to how they created the models, sorry, the strategy. And perhaps, let's say after we watch the FinRL talk with Michael, perhaps it's not as hard to actually adopt the strategy ourselves. So that's probably something I'll work on myself to try and maybe get more results and more understanding of whether or not deep reinforcement learning is actually potentially worth to implement in a strategy. So this is how I would want you to conclude, or this is how I'd like to conclude today's reading group. Number one, the 3 pillars of financial trading. Now, this is how the world of financial trading is governed today: fundamental analysis, technical analysis, algorithmic trading. And all of these 3 are not independent, they interact with each other. And in most cases, you will always use either one of them, or both, or all 3 when you're building a strategy. Number 2, deep reinforcement learning and its components. We understand that reinforcement learning at its core is governed by action space, state space, which is environment, and reward. And at its core, that's deep reinforcement learning. Where deep reinforcement learning takes a step up is using deep neural networks. And these deep neural networks are used to understand the interaction between the state, which is your environment with all your variables, your indicators, and so on, and the reward function. So state, action, reward function. And then the setup. The setup is important because perhaps the results are biased to only a scenario that's specific to this setup, which is the state space they use, and also some of the indicators they use to judge how they constructed the portfolios. These things are important because this is where we are maybe can do more experiments to adjust so that we can see whether or not this is something we can add to a strategy or not. Perhaps it's prone to overfitting in other scenarios or not. So the setup of the experiments is very important and something that needs to be understood. And then, of course, more results are welcome. I think this is in line with point number 4. We just need more results. We need more scenarios. We need more test scenarios. We need more understanding of which variables work better in environment and so on and so on. And then I think the final point I would want you to go with is DQN dominates. DQN, deep Q learning networks or algorithm, it's essentially an algorithm that's been well researched for a long time. Like I mentioned, Q learning algorithms started in the early 80s, and as more and more advancements were made in computing, so as the algorithm started to move from Q learning algorithms to now adapt deep neural networks to actually make the looking of the environment even more precise and better. So perhaps, if anything, let's say the results for you are not convincing enough, maybe you don't feel like they're well experimented, they didn't do set up the experiment well and so on, I think that's fine. But if there's anything you can take away from this paper, is that perhaps you need to understand how you can adopt DQN in a strategy, or how you can test DQN in a strategy so as to try and make better and better rewards, or optimize better and better rewards. Because I think whenever we're faced with unprecedented times like we have, where the market is extremely volatile and we're essentially going through a recession in other parts of the world, I think we need models that can understand data even better. And I think DQN is one of those models that can do that. And perhaps also remember, I mentioned policy gradient and A2C are not deep reinforcement learning, but they do have deep reinforcement learning counterparts. Like, for instance, your deep deterministic policy gradient for policy gradient, and then your A3C for A2C. And with that, I would like to conclude. I hope you enjoyed today's talk. I certainly enjoyed reading the paper, and I actually look forward to trying out more and more scenarios that could lead to different results and so on. Because I think it's always nice to have a nice spectrum of results, so as to have a very nice overview of how you'd want to approach your strategy. So thank you.